current state of the U.S. economy presents a mixed picture, with recent data showing both strengths and signs of potential weakness. After a period of contraction in the first quarter of 2025, real GDP rebounded with a 3.0% annual growth rate in the second quarter. The labor market, however, has shown some cooling. Recent job reports indicate a sharp slowdown in hiring, and the unemployment rate has ticked up slightly to 4.2%. Inflation remains a key concern, with a primary inflation gauge rising in June, driven in part by new tariffs on imported goods. The Federal Reserve has held interest rates steady, but is facing increasing pressure to consider cuts to support the slowing job market. The ongoing tariff policies are creating a great deal of uncertainty, with businesses and consumers grappling with the potential for higher prices and supply chain disruptions. Overall, the economy is in a period of transition, with policymakers and analysts closely monitoring these developments. The main reasons behind Apple's new $100 billion investment in the U.S. are directly linked to recent shifts in trade policy and a desire for greater supply chain security. The primary driver is likely the looming threat of new tariffs, specifically President Trump's proposed 100% tariff on imported semiconductors and a 25% tariff on Apple products manufactured overseas. By committing to this massive domestic investment, Apple is proactively seeking to avoid these costly tariffs, which would significantly increase their expenses and could lead to higher prices for consumers. This strategic move is also part of a broader trend of reshoring supply chains. The company is aiming to reduce its reliance on a complex international manufacturing network, particularly its heavy dependence on China. By expanding its U.S. manufacturing footprint and building partnerships with domestic companies like Ford and Apple, can create a more resilient supply chain, mitigate global trade risks, and align its business strategy with the America First economic policies of the current administration. Apple's new commitment is expected to have several significant consequences. The most immediate result is the potential for the company to avoid substantial tariff costs, as its domestic investment is seen as a way to appease the administration's trade demands. This could help stabilize the company's financial outlook and prevent a major hit to its profit margins, which were already being impacted by existing tariffs. For the U.S. economy, the investment is projected to create tens of thousands of jobs and boost domestic manufacturing. By focusing on components like glass and semiconductors, Apple is strengthening the American supply chain for critical technology. This could lead to a ripple effect, encouraging other tech companies to follow suit and further invest in American production. However, it is important to note that analysts still believe a full transition to made in the USA iPhones is not easy, and the investment likely represents a partial strategic shift rather than a complete overhaul of its global manufacturing model. For companies like Apple facing trade tensions and potential tariffs, the most common solution is to diversify their supply chain. This involves shifting production, sourcing components, or assembling products in countries that are not subject to tariffs. For instance, the company might adopt a China Plus One strategy, maintaining a presence in China while also building manufacturing hubs in other nations like Vietnam, India, or Mexico to reduce risk. Another crucial solution is to strategically invest in domestic production. This is the path Apple chose, and it is a powerful way to mitigate tariff exposure by moving some manufacturing back to the U.S. It also aligns with political incentives and can earn goodwill. This approach requires significant capital and a long-term commitment. Finally, companies can engage in tariff engineering, which involves redesigning products or their packaging to classify them under a different, lower tariff category.